once again, St. Louis. Welcome to What Retirement Means to You with Jerry Means. He is a financial advisor and the founder of the Means Financial Group. I'm your host, Spike Spangle. Jerry, how are you doing this week?
I'm doing great, Spike. How are you?
Wonderful. I'm glad of all of the information that you've collected and put together today. We're going to be talking about income strategies in retirement. There's a lot of advertising out there right now. I want to kind of sift through what is the news, what is the noise, what is reliable for you, because income strategies are, of course, very important for retirees. Ready to hop in?
Absolutely.
Well, if we talk about income, I would say probably the very first thing that comes to mind in retirement is our Social Security. So let me ask, how do you feel about it? Is it going to be there? What's a good percentage to kind of rely on in retirement? We don't want to go over a threshold of, let's say, 50 or 60% of our income. How do you feel about it to start with?
Well, I think the key is just to make sure that we maximize the benefits that are available to us. And one of the most dangerous things, I think, for consumers is water cooler advice. You know, they hear, you should just start at age 72 because, it may not be there when you're ready for it, or it may be, reduced by 75% when you're at full retirement age. Then you have people that maybe tell that same consumer, hey, you should wait until you're age 70 and draw it out, pull off of your assets first and let it grow. The truth is, it's different for everyone. And when people come into my office, people just like you that come in, one of the number one questions I get, you're not alone, is when is the best time to draw Social Security? And the answer to that question is not when is the best time. I mean, if you want to get the most out of Social Security, absolutely you wait till age 70. But that's not an option for everyone, and it doesn't make sense for everyone. It's also not to draw it as early as you can. I had a client that was a consultant. He's an engineer, did a lot of consulting. He was getting kind of tired of the career. He still wants to be in the career, but not with the same corporation that he's worked with for most of his life. Decided to retire, draw Social Security. This was his plan when he came in to meet with me. But then he was going to make about $50,000, $60,000 a year working part-time consulting. And I had to say, hey, well, pump the brakes. If you draw Social Security at age 62 and your full retirement age is 66 and 8 months, if you make more than $19,000 and some change, they change it every year. I think this year it's $19,800, something like that. If you make over that, a dollar for every $2 that you make, you have to pay back to Social Security. So it's a pretty big penalty in the IRS code.
So your Social Security isn't just free money that you're taking at 62. If you're continuing to, if you take money beyond your $19,000 that you're getting from your Social, you're going to be taxed on it, and you're giving it back.
Correct. I mean, that's earned income if you're out working part-time. They're not looking at pensions and things like that. Okay. But if you're going, retire from your job, draw Social Security, and then work part-time, you want to stay under that limit. If you're going to go above that limit, you're going to get 50% of the benefit back anyway, and you took a reduced benefit, so it doesn't make sense. So for him, it didn't make sense. Let's go ahead and look at your assets, and let's draw off of those instead until you reach full retirement age, or you decide you don't want to do the consulting anymore, and you get below that $19,000 number. So it's also not 62 or full retirement age. Lots of clients want to work until they're age 65 because of Medicare, right? Because health insurance is the biggest thing that they're going to face, or one of the biggest expenses they're going to face in retirement. And once they retire at 62 or 63, they have a 2-year gap before they're eligible for Medicare. So they got to go out to the private sector, find private health insurance, and it can be very expensive. So a lot of clients work till age 65, draw that benefit at age 65, get Medicare, Medicare Advantage, or Medicare Supplement plan. And then, they might do some part-time work, but they stay underneath that limit until they hit full retirement age. Then they don't care how much you make. It could cause tax on your Social Security, but there's not that penalty of $1 for every $2 that you earn.
What about, because we always hear this number of $1 million. If you got $1 million saved, hopefully that's going to be enough for retirement, and you get to 62 or 64 or even your full retirement age. With Social Security and $1 million, is that enough to be retired for 30 or 35 years, or is it a little bit harder now?
Well, we have to look at your expenses in retirement. And I always tell people start with the MUG, right? The MUG. But it's just an acronym for mortgage, utilities, and groceries. Those are your essentials that you're going to need even in retirement. So what we have to do is look at, okay, all your income sources, Social Security, pensions if you have that. What is your income gap? If you need $60,000 a year to fill your MUG, but those benefits only pay 30 and you're going to need $30,000 off of your investments, we have to look and decide, if we put $1 million over here, what buckets are we going to put that in to draw that $30,000 a year to make sure that you don't run out of money? So it's different for everyone. It's what are your expenses going to be?
It sounds like a lot of the folks who call and ask you for advice or come into your office are people who are not just turning on Social Security, but also either have other income or other assets. There's not a lot you can do for someone who is completely relying on Social Security for retirement. And it's also a very tough position to be in.
Yeah, I mean, if you're downsized and you don't want to go back to work, or your health is failing and you have to retire for health reasons, you don't have the option to go back and work part-time, and maybe you don't have a pension, and you don't have enough assets to sustain that mortgage, utilities, groceries, you may have to draw Social Security at age 62. For that person, it makes sense, but it's different, again, for everyone.
You also, we had talked about this, that sometimes if you do want to start that income stream and continue working, if you're the one working and your spouse isn't, maybe we could turn on the spousal benefit a little bit earlier. You could wait on your own Social Security. Correct.
And especially if one spouse is older or is the breadwinner or the higher income earner. Because when one spouse passes away, what the living spouse gets is the higher of the two Social Securities. So let's say, for example, the husband has, it's not always this way, but let's say the husband has the higher Social Security than the wife. If the husband passes away, the wife gets his check, but her money just kind of went away, right? It's gone. If she passes away, he's still going to get his check because it's the higher of the two also. So it might make sense to turn her Social Security check on, go ahead and get that, because if she outlives him anyway, that benefit goes away and he gets his, and it's not a reduced benefit. So yeah, sometimes the strategy is to kind of split it and have one spouse turn on the income to help, from depleting the assets, and let the other spouse go ahead and defer that into full retirement age.
So hopefully in a comfortable retirement, Social Security is one of your income streams, along with your other investments. What I'd like to do with you throughout this program, though, is talk about other income streams, everything from CDs to bonds, even dividend-paying stocks. We're going to talk about all of those opportunities. But can you explain a bit about the On-Track Retirement Review and how you help evaluate with Social Security, how and when to take it, along with the rest of your investments?
Absolutely. So what we're going to do is, for the next 10 callers, we're going to offer our On-Track Retirement Review. There's no cost, there's no obligation, there's no pressure. Social Security, when to take Social Security or Social Security timing, it's just a part of the puzzle. We're also going to look at tax planning. We're going to look at a written income plan, all of your other sources, and how do we meet that income gap that you're going to need in retirement? How do we combat inflation? And we look at health insurance and long-term care along with longevity. Those are all things that we can help you with on the On-Track Review. So pick up the phone, give us a call, 844-878-1293.
Thank you very much, Jerry. We got to take a very short break. Call right now so you can get your own On-Track Retirement Review, 844-878-1293. We're going to continue to talk about income sources, how you use them, when to take them in retirement, when we get back with Jerry Means right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. Every single week, Jerry likes to provide you retirement planning solutions. This is an awesome program because we're talking about income solutions in retirement. And it's interesting, we use that word in retirement, but for the most part, unless we're consulting or working part-time, we're not really producing a salary so much. So I guess you paid income. So these other income sources. Let's talk about CDs. CDs aren't really something we were able to use over the last 5 or 10 years. There were no interest rates worth using, correct? But are we in a changing environment?
Absolutely. I mean, I remember, going back to the 1990s. I've mentioned on the show before how close I was with my grandfather, and I would kind of hang out with him. And I remember going to the bank one day, and he was really barking at the teller at the bank because he was upset because he had an 8% CD renew at 6%, right? He was so upset. I'm going to move my money to a different bank, right? Today, you'd be
lined around the block for
6%. But we are starting to see rates go up because of the Fed raising interest rates. So some of those CDs are starting to become more appealing. But I really only like them for short durations or really short-term needs because there are other vehicles that can pay as high as 2 to 3% fixed interest, higher than what a CD is. So they're still not necessarily the best game in town. There really isn't a best game in town. It's all part of the puzzle. But for a short-term need, if someone says, hey, Jerry, I need to buy a car next year. I think my car's about had it. Or this money is for my grandkids' college. I'm going to help pay their tuition next year. We don't want to take risk in the market. We don't want to tie the money up for long. Go ahead and we'll put that in a 1-year CD, get the best rate that we can, but we want that money to be available and liquid. It's also okay for maybe an emergency fund because the penalty on a CD might be 6 months interest or something like that for your emergency money. That's okay. But any longer than that, we want to look at a different bucket. And I always talk about the bucket strategies.
Right. What about bonds right now? So bonds had done well for 30, 35 years. You've spoken on another program how last year our markets were correlated. Both the stock market and the bond market went down at the same time. You've explained the teeter-totter. As interest rates rise, bond values go down, and that's what happened last year. Is this the same environment for retirees to be able to use bonds safely going forward this year, or is that risky?
I think there's still a lot of risk in bonds right now. I'm tending to show people bond alternative. There's other things out there that people can do besides the bonds. But if we are going to go into bonds, we want to keep them short durations. Because again, we're in a very interesting time where 3 and 5 year bonds are paying the same or better interest rates than 10-year bonds, right? So you would think logically that a 10-year commitment would pay a higher interest rate. But that's not what's happening right now. We're looking at short-term rates being higher. If you're going to go into bonds, I would stay away from the bond funds because the bond funds don't have maturity. So if you buy a 3-year bond paying 4 or 5%, you're only into that for 3 years, right? So you don't have a long commitment. A bond fund can be open-ended, and it can inside there's a turnover, and there can be some volatility inside that bond fund. So if you are going to be in bonds, I like to use the short-term bonds, and I think you should use high credit bonds as well because in a rising interest rate environment, there's also credit or default risk as well. So that's something you have to look at.
But very, very interesting. And I think a lot of folks have gone over to funds. It's a little simpler. They'll talk about what the styling of that fund is. But do you see retail investors going out and sifting through and purchasing individual bonds today like they used to?
Not very many. Occasionally I have a client that they have their spreadsheet and they enjoy doing that. Usually that's my engineer clients, and that's okay. I mean, they're built differently, and that's not meant to, anything against engineers. I love engineers. We couldn't do anything without them, and I have lots of engineer clients. But mechanically, they're more designed for that. Most people don't want to take the time or don't have the patience to go through and really try to find the best bonds out there. So no, I don't see too much of that. Now, we do that for people in our office, or we have done that in the past. Like I said, we're starting to steer away from bonds as they're maturing. We're trying to move them over into some alternative things.
And as a reminder for your audience out there, you're not just a broadcaster talking about the financial markets right now. You are a financial advisor, and that's what you do with the Means Financial Group, is help people with these income strategies. I know over a cup of coffee, you and I were talking about this. What about dividend-paying stocks, dividend-paying funds that have stocks within them and so forth? Is this an interesting sector right now?
It is, and I'm a big fan of dividend-paying stocks, but again, it's not the end-all thing. It's a part of the puzzle, just a part of the pie. We see all these shiny objects out there. People are always chasing it. They're looking at, the gold and the crypto and, whatever the next phase is. The truth is all of these things are really part of the puzzle. There's no one, I'm not going to say any names, but we see some people that, stand on the camera on some of the big talking head shows and say, I hate annuities, only buy stocks, right? Mm-hmm. Well, stocks aren't the end all, even if they're dividend paying stocks. They can be a part of the puzzle for the growth end, but they may not necessarily be the best income tool because they're not guaranteed, right? So again, we like to take the money, put it into different buckets to accomplish different things. We want to have an emergency bucket, that you can go and get mm-hmm. into. We want to have an income bucket. Then we want to have a growth bucket for the back end of your retirement to combat inflation.
All right, well, you brought it up, so I got to ask you. Gold, we see commercials for it all the time when there's market volatility. Are you a fan of it?
I think it has all precious metals. I think you can have a portion of your portfolio allocated to it. Now, I'm not talking about that investor out there that likes to have gold coins, and maybe they collect it with their grandkids and keep it in the safe. That's not what we're talking about. But you see these fear-mongering commercials, the dollar isn't going to be worth anything. So call into here and, let's put you in a brokerage account and buy all gold bullion, right? And then we'll hold it for you and charge you a fee and do transactions for you.
Yeah.
It always is comical to me. The dollar's not going to be worth anything, so send us your dollars and we'll send you gold, right? Right there, it's kind of counter. It doesn't make sense.
Speaking to our fear, because people don't know what to do, and like you said, the bright shiny object. We're like, where do we go? Where do we get income? I don't want to run out of money in retirement, but for you, it's about a plan. It's not a product.
Yeah, maybe you put 10% of your portfolio in gold as a hedge. That's okay, But also, the price of gold can be just as volatile as the stock market. People don't realize that. Yeah, it's going to be there, but the price is volatile.
Right. So within the on-track retirement system and what you do, are all of these things then part of it? It sounds like could be a little bit of everything in there.
Absolutely, and that's what we're going to offer today to the next 10 callers is our on-track retirement review. If you'd like to see what your bucket strategy would look like, come in, let us get to know you. Let's talk about what you're trying to accomplish, when you're wanting to retire, and we'll show you how we can design that bucket strategy for you. We'll talk about taxes. We'll talk about inflation. We'll look at longevity and health care. We're going to look at and do a written income plan. And it's no cost, no obligation. You have nothing to lose. So give us a call, 844-878-1293. It'd be great to set you up with that on-track review.
Jerry, we're going to take a very short break, but you opened up another Pandora's box. You said annuities, so I got to ask you about annuities when we get back from this. Folks, you're watching What Retirement Means to You with Jerry Means. He's a financial advisor and the founder of the Means Financial Group. He wants to do for you your own on-track retirement review, taking a look at your investments, which include your income strategies, taxes, estate planning, your healthcare choices down the road, and making sure that it all works together. All by you calling the phone number right here, 844-878-1293. More with Jerry Means right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. Jerry, we're talking about income strategies in retirement today. And we've already hit from CDs to bonds to dividend-paying funds and stocks themselves, from our Social Security. But there's one more in there that I think folks are hearing a lot of right now, especially with the word bonus. I'm curious about these advertisements. How do you feel about annuities? Do annuities fit into your on-track system?
So I work in the retirement market. Most of my clients are 50 or 55 and over. And I like annuities in a portfolio. I think they're not, again, they're not everything that you should have, or the only thing that you should have, but they're a good piece of the puzzle, right? Stocks, bonds, mutual funds, CDs, annuities, they all have their place as part of the puzzle. The thing is kind of being, it's like an orchestra, right? And you have to have a conductor to help you put those in and figure out where do they fit in and what bucket. I always talk about the bucket strategy for income. Annuities are great for the income bucket. Now, first, you have to understand there's three types of annuities. Okay. The first annuity is a traditional fixed annuity. And today, most of those are called multi-year guaranteed annuities. It's a mouthful to say. The acronym, the financial world loves acronyms, but it's called a MYGA, multi-year guarantee annuity. And you can buy these annuities at 3-year terms, 4-year terms, 5-year terms. Now, with those, usually the longer you go, I'm kind of finding that the 3 and 5-year are the sweet spots. But you can get anywhere to 4 to 5% guaranteed fixed income right now, which is a pretty good yield. I talked earlier about using bond alternatives. The MYGAs can be a great bond alternative. If you have 50% stocks, maybe you look at a dividend stock portfolio. If you have 50% bonds, maybe instead of having that volatility in bonds right now, you grab a guaranteed fixed rate of 4 to 5%. It can be a great alternative, and they can blend together. Then you still have your emergency bucket and your growth bucket that way. But the middle one is a fixed indexed annuity, where you can get some of the upside of the market, but none of the downside risk. So again, a fixed index annuity, if you put $100,000 in or $1 million in, and the market goes up 20%, we have a great year. We're all wishing for that, right? You might be capped. Different companies have different cap rates, but right now the caps are usually around 12. So if the market goes up 20, you're only going to make 12, but that's okay. 12% is still a pretty good return, reasonable rate of return, and it's better than the 4 to 5%. If the market goes down and it's negative, you get a zero. You don't make any money that year.
So like last year. So if the market went down 22 to 25%, I mean, if you look at the S&P or the Dow Jones, so if the market went down 25%, you're saying if whatever you had invested in that portion of it, you would have been at zero.
Correct. Zero is your hero.
Have no loss.
Zero is your hero. When the alternative is a negative 18, 20%, you're okay with zero. Waking up with as much money as you went to bed with, right? So I like the fixed index annuity for retirees because they don't have that roller coaster ride. And over a time, that higher cap might outperform the short-term MYGAs. Now on the far end, you have variable annuities. I'll be honest, I'm not a real fan of variable annuities, especially in a retiree's portfolio, because they have a lot of fees that people don't understand. If you put $100,000 into a variable annuity and it drops down to $80,000 because it's in the market, that's why it's called a variable. If you need the money, you only have $80,000. But if you die, it'll pay your original investment of $100,000, but you have to die to get that benefit. It doesn't do anything for you, it's more for your heirs. And it's not free. You're gonna pay a fee, usually about 1.25% for that. They have mutual funds. Also, they charge a fee around 1%, where you could buy outside of a variable an ETF and pay maybe 0.10% fee, right? So it's a lot more expensive. If you add riders, I see those variable annuities sometimes somewhere between 3 to 4% a year in fees once we really break it down. So I'm not a fan of the variable annuity, and I'm a big believer that maybe annuities have gotten thrown out with the bathwater because of the variable annuities. That's just my opinion. But I think the fixed and the fixed index can be a great tool.
It's like different vehicles out there. There's all different kinds of automobiles, and maybe it sounds like the variable annuity is more like a motorcycle. You don't think they're safe, they're not really good for somebody in retirement. although there's a lot of motorcycle riders out there, that's totally fine. But for your kind of client, that's not the kind of safety. But I love your term MUG. So that's the mortgage, utilities, and gambling money, right?
Groceries.
Groceries. All right, I'm sorry, the groceries. But so we want to cover the MUG money, and that's what the income is all about. If I wanted to use something like an annuity, would I take all of, let's say, the $500,000 that's in the retirement account, or do we parcel it out? Tell me how that works.
Absolutely not. And that comes back to the on-track review and designing that bucket strategy for my clients. We want to make sure that you have that emergency money. We want that to be in a safe investment where you can get to it any time that you need. But we want to look at your Social Security and your pension. What is that going to pay for you and your family during retirement? We want to look at what your MUG is, your mortgage, your utilities, and your groceries. What is that going to cost you? What is your budget in retirement, or projected budget at least? If it's a $60,000 budget and Social Security and pensions cover $30,000 of it, you have a $30,000 income gap. We may look at that $1 million portfolio and say, how much of that do we need to put in something that's going to produce guaranteed income, maybe like the fixed index annuity, that's going to produce guaranteed income to cover that gap, right? That meets your essential needs. The remaining amount, we might want to go over and look at things like, short-term bonds or stock dividend portfolios and things like that are still in the market, but we're trying to outpace inflation for the long term. So again, it really just comes down to figuring out your strategy. I think the financial world makes things more complicated than it needs to be. And that's what I hear from my clients when they come in. Like, Jerry, you just made it sound so simple, right? And I'm like, well, I have all of the reports and I can make this complicated if you really want me to, but you're not going to really remember what we talked about. But people remember MUG. They remember that I have a guaranteed income stream to fill up my MUG or to cover my MUG, and that I'm still going to have discretionary money, right? We call it paychecks and play checks, right? You want to have the paychecks to cover your essentials, the play checks to do the things you want to do, like golfing, traveling, and those sort of things.
So with all the research that's out there and all the different income strategies, it's not one solution. It's not one lever you can pull. It's kind of pulling them all together. And then for different timelines in your life, the money you're going to spend right away, the middle money, and then the money way down the road.
Couldn't have said it better myself, Spike.
Well, thank you very much. I'm learning from the best. Thank you, Jerry. We're going to be back again next week. Folks, call right now or take the phone number down. If you need to step out of the room for a moment, go get some more pretzels for the next program. The phone number here is going to get you your own on-track retirement review. Call 844-878-1293. Thank you so much for watching What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. Jerry will be back again next week.